hovering around 4,700 right now. Now, many expected gold to go ballistic when the war in Iran started, and yet gold has been down to sideways since the conflict began. Why do you think that is, and what is your overall assessment of the gold market at present?
Again, when it comes to the war, that's a rabbit hole. And of course, predicting the war, criticizing the war, praising the war, debating the war, I'm the last person to give an opinion. I'm probably the last person anyone wants to hear that opinion on. So I try to stay out of the armchair quarterbacking on the war and my views of it, or its duration, or its goodness or badness. We all have very strong opinions on that. What folks like I can do is certainly look at it economically, and not just in terms of precious metals. And again, you could spend hours on it. You can look at the parties of this war. You can look at the economic risks of this war. But I think, what we saw, and I've said this many times, it wasn't a necessary shock. You would think if gold loves chaos, what can be more chaotic than a major military conflict in the Middle East at the Strait of Hormuz with a supply shock in oil? And why wasn't gold ripping? And the sad reality is there were sell-offs in in gold, not because it was a desired sell-off, but because it was a forced sell-off. And I did a lot of different reports on different countries like Turkey, which has to import the vast majority of its oil and gas through the Middle East. When this war lasted more than 2 weeks and the last ships came through the strait in late February, there was an uh-oh moment in a lot of parts of the world. And Turkey's in a classic example of having stacked gold religiously, metaphorically, but at a fundamentally meaningful level. They saw the writing on the wall for the lira and paper currencies, and they were stacking gold significantly prior to the war, had to sell 10% of their oil early on, had to sell 10% of their gold early on just so they could afford to buy higher priced oil. And they needed that oil to function as a nation. So that was an example of a forced sale of gold. Again, I keep confusing, a forced sale of gold to buy oil. But what was interesting, when Turkey did that, it was a swap through Switzerland. A swap, without getting into all the weeds, is kind of like a pawn shop. You could say, I'm going to sell you some gold, but I want to buy it back later. They did a swap for 10% of their gold holdings, just to survive because the world survives on energy, despite what Greta Thunberg says. We need oil, we need energy. And so that was kind of a forced sale because they needed to sell gold to buy oil. On the flip side, you see a lot of the GCC countries, including Saudi Arabia, having to sell some of their gold, over 50 tons, we think, not to buy oil. Obviously, they have the oil, but they needed it to buy everything else because they import most of their food and other products. And so they had to sell their good assets, their most valuable assets, their most liquid assets that they didn't want to sell, to buy products. So you have two extreme examples of Saudi Arabia and Turkey, who are very fundamentally in favor of gold, forced to sell it because it is their most valuable and liquid asset. And if this war drags on, you could see that. So that was one clear cause. Those are large amounts of gold sales. And when you have large sell-offs, you have a price reduction. You also saw a lot of levered ETF, I call tourists in the gold space, that saw the all-time highs in 2025. And we're in levered ETFs, 2 to 3 times levered. Those rebalance daily. If you're a genius when gold is ripping, you look very less intelligent when gold is falling. Because they rebalance daily, there was massive ETF sell-offs. That was clearly another force on the downward pressure of gold during the fog of war. And of course, a lot of the shadow banks, the hedge funds, they're not holding gold as a preservation asset. They were trading it for arbitrage. They were very levered. They all track the same algo signals, the same stop loss signals. And when they hit those, they started to sell en masse as well. So between the institutional hedge fund smart money, between the ETF tourist trade, the speculators levered, and between the forced sales in the Middle East and other parts of the world to pay for other products, there was a sell-off in gold at a time when you thought it would rip. It's certainly not peak gold, and we can get into that, and there's a lot of reasons, but the sell-offs were not a shocking surprise. It's just like you see when you see the S&P get an uh-oh moment. It's not uncommon. It's a margin call. You have to sell the good to cover the losses of the bad, so your best assets are paying for the sins of your worst assets. And that, we talk to clients all the time, in the next uh-oh moment in the S&P, the Dow, the NASDAQ, if we see a retracement, you're going to see a likely sell-off in gold too. The question is a sell-off from what price? If you're trying to time that as a trader, will gold sell off again? Will the market crash when gold's at 5,500, 6,000, 5,700? Nobody knows. If it's sold off today, of course, you would use that as a sale price. But if you're a long-term investor, and we're looking 10, 20 years out, whether you bought gold at 4,500, 3,800, 5,200, or 6,000, yes, of course, I would have liked to bought gold at 300 like Egon, but I'm still glad I bought it. I'm saying for the long-term investor, not the trader, I'm no help to the trader. For the long-term investor, we see gold at significantly higher prices than we do today. War confuses a lot of things. We're not panicking by sell-offs. In fact, most of us and a lot of our clients are buying in these sell-offs. But not everyone can afford that. Not everyone can think that way. And certainly if you're looking to get rich on gold, we're not the people to give advice or to trade on gold or to lever it. We're not the ones to talk to. But war has certainly confused a lot of things. It wasn't a shocker to see the sell-offs. We're not worried about it. I am much more worried about what the war will do to the markets and to the economy longer term as this war drags out. Again, whatever you think of it, most people are against it, understandably. As von Clausewitz said, war is an extension of politics by another means, but politics are an extension of economics. And the economics of this war, it is an oil war, it is a dollar war, it is a U.S. Treasury war, it is a petrodollar war. Again, whatever you think of the ideologies behind it, the economics of it are fairly simple. And the longer this drags out, the more stress it puts on the markets and on the economies of the world, recessions, market drawdowns, the inevitable fiscal and monetary stimulus to follow, whether it ends tomorrow or whether it ends in a month, that stimulus, that expansion of the money supply, that balance sheet expansion, and that uh-oh moment is ultimately going to be a massive tailwind for gold over the many years to come. And as I'd like to say, we ain't seen nothing yet. And again, that's selling my book, but that's understanding history. And we're far, far, far from peak gold. Even I think the bears can expect that. And when you see Goldman Sachs or UBS or JP Morgan, especially at Goldman, the world's greatest investment bank, the massive bank we're all familiar with, when you see their head commodity trader or their CIO more bullish on gold than half the gold camp for year-end targets, I'm not a big fan of these banks. I'm not a big fan of the BIS. I'm not a big fan of central banking in general or commercial banks for a lot of different reasons. But I even have to agree with them. They're starting to see what they wouldn't admit years ago. So whether it's a gold bug, whether it's a bond jock, or whether it's a Goldman Sachs a commodity trader, we're all kind of aligned now on where gold is going longer term. I don't think anymore it's an apology for the metal.